With all of the recent headlines, you would think that the US economy has made a full recovery, with consumer spending up almost 11% and household income in the month of March spiked over 20%. But what you probably haven't heard is the percent of household income that's being derived directly by the federal government. And that is at 35%. Yes, you heard that right. 35% of all household income so far for the year 2021 has come directly from the federal government. In this week's video, we'll cover the market returns, the chart of the week, which shows the percent of household income that's being funded directly by the federal government, and we'll follow that up with a news story as to how stores are actually hiding inflation. Taking a look at the market returns from last week, all of the major indexes were actually negative except for the S&P 500, which was surprisingly flat. The NASDAQ continues to be the lagger and the only US major index that is not at double digits. Moving over to foreign and emerging, emerging continues to have a rough time with the coronavirus cases in India spiking to over 400,000 per day. The chart we're looking at this week is the direct transfer payments from the federal government as a percentage of household income. And I wanted to show this chart to really put into perspective where we're at today versus where we've been at historically. As you can see on this chart, for about 60 years, we've hung out between 10 to 15% of household income directly funded by the federal government. We're now currently sitting at over double that. As the federal government continues to print money to fund household income, we are going to continue to see the price of goods increase for not only consumers, but businesses as well. I now want to cover the topic of shrinkflation. Shrinkflation is the tactic that companies use to trick you into believing that you're buying the same product that you've been accustomed to buying for years, but in reality, you're actually purchasing less of the product. Some examples throughout history have been peanut butter companies raising the bottom of the jar, but not changing the overall packaging, so you're actually purchasing less. Ice cream lids being pushed down or the bottoms of the containers being pushed up. And most recently, this hit the news, a consumer that has purchased paper towels from the same big box retailer for years saw that their paper towel roll went from 160 sheets per roll down to 140 sheets per roll for the same price. That is an 8.75% decrease in product, and that is hidden inflation. Some other products that are currently experiencing shrinkflation are Powerades have gone from 32 ounces down to 28 ounces. Cans of tuna have gone from 6 ounces down to 5 ounces. Also, bags of chips have gone from about 15 ounces a bag down to 13 ounces of product, and all of these things are in the same containers. Now, what you're going to start to see is companies that cannot alter their packaging anymore will gradually increase pricing over time. A penny here, a penny there, so you don't notice the price increase. And this will continue to cause inflation throughout the economy. Now, the Fed has already stated that they're not going to look to raise rates until 2024 unless inflation remains over 2% for an extended period of time. We are fearful that the Fed is going to have to step in and reevaluate that decision. So we're adjusting our investment philosophy and our portfolios accordingly. This was Matt Fox from Perspective Wealth Planning with what you need to know about the markets in 5 minutes or less. If you're on YouTube, make sure you subscribe to our channel, and if you're on Facebook, follow us there as well.